The U.S. economy should already be on its knees. Every warning light is flashing at once: household debt at historic highs, savings drained to the bone, inflation grinding down every paycheck, and wages that can't keep up with reality. By all logic, the system should have cracked, but it hasn't, and that's the real danger. Because once you look beneath the headlines, you realize the crisis everyone fears isn't the one that already happened. It's the one the government has been quietly postponing. Not with speeches, not with optimism, but with hidden supports designed to keep the collapse from arriving too soon. Here is the truth no one in Washington will say aloud. Economies don't break when things look bad. They break when the invisible pillars holding everything together finally snap. So let's break down the data that almost no one talks about. First, the economy is operating on contradictions. Consumer spending, the backbone of the U.S. economy, is still high, but personal savings are near historic lows. Americans aren't spending because they're comfortable. They're spending because they're trapped. Credit card balances just crossed $1.4 trillion, an all-time record. Average APRs are hovering near 30%, yet people keep swiping. Why? Because they have no choice. They're covering groceries, rent, medical bills, not luxuries. This isn't confidence, it's quiet desperation. And that's when the first uncomfortable truth appears. The U.S. economy hasn't crashed because it's running on borrowed money. Not borrowed by the government, borrowed by you, the household. Borrowed by people who know they can't afford it, but also know they can't survive without it. But here's the twist almost nobody sees. Household debt is only the first pillar holding up the system. The second pillar is far bigger and far more dangerous. While Americans max out their credit cards, the U.S. government is doing the same thing, just on a scale so massive most people can't even imagine it. The government now carries over $38 trillion in debt, not total liabilities, actual federal debt. The interest alone is more than $1 trillion per year, larger than the entire defense budget was a decade ago. Let me repeat that. The U.S. now pays more in interest on its debt than it spends on Medicare, education, veterans, transportation, or social programs. This is not sustainable, and the government knows it. So why hasn't the economy crashed? Because Washington is quietly propping it up. Not with stimulus checks or emergency programs. Those ended years ago. But with silent, disguised injections that never make headlines. Expanded federal lending programs, corporate backstops, emergency liquidity windows, off-budget spending, debt refinancing loopholes. Money is flowing into the economy whether voters approve it or not. It's not traditional stimulus, it's shadow stimulus, and the government hopes you never notice. But there's a third force at work, one even stronger than household debt and government money. The U.S. economy hasn't crashed because inflation is doing the heavy lifting. This sounds insane, so let me explain. When prices rise, corporate revenues appear to rise too, even if sales volume falls. If a company makes $100 selling 10 items at $10 each, and inflation forces them to raise prices to $12, they can make the same revenue selling fewer items. It's not growth, it's illusion. And Wall Street loves illusions. That's why companies keep reporting record earnings, why GDP numbers look resilient, and why politicians brag about the supposed strength of the economy. The system looks healthy on paper because inflation inflates the numbers. But here's the part no one wants to touch. Inflation doesn't just raise prices, it erodes the dollar. Every dollar in your pocket buys less. Every dollar in your bank account is worth less. Your financial stability is being drained quietly, inch by inch, and that slow bleed is what's keeping the system alive. This is the secret. The U.S. economy hasn't crashed because it's being artificially held up by debt, inflation, and government liquidity. Not because it's strong, but because it's being kept alive. And now we reach the most disturbing question. If the economy depends on weakened dollars, record debt, and hidden stimulus, how long until one of those pillars finally snaps? Because when it does, the entire system will feel it at once. And that brings us to the next force, the one most Americans don't see coming, the one already reshaping the global financial order. What comes next is the part most people never learn, even if they follow the news every day. Because everything we've talked about so far, household debt, government debt, inflation, quiet stimulus, is only the surface. To understand why the U.S. economy hasn't crashed yet, you have to understand the deeper forces holding it together, forces that are already weakening beneath your feet. The first force is the Federal Reserve. Most people think the Fed controls the economy by raising or lowering interest rates. That's the surface-level explanation politicians like to use because it sounds responsible. It sounds like someone is in control. But rate policy is only a fraction of the story. What the Fed has been doing quietly, with almost no public attention, is far more significant. It has been managing the economy through liquidity engineering, backdoor market support, and financial plumbing most Americans never hear about. Repo facilities, emergency lending windows, balance sheet reshaping, and dollar swap lines have become the invisible scaffolding that keeps the economy standing. This is the reality. The economy hasn't crashed because the system is being held up by invisible beams the average voter will never see, and those beams are bending. Take the Treasury market, the backbone of global finance. For decades, U.S. Treasuries were considered the safest asset in the world. They were the foundation of dollar demand, the benchmark for global stability, the trust anchor for international trade. But something changed. Foreign demand for U.S. Treasuries has been quietly fading. China has reduced its holdings. Japan has been forced to sell to defend its currency. Oil nations have diversified. Even smaller economies have started turning to alternative arrangements. None of these moves collapse the system on their own, but together they weaken the global demand for U.S. debt. And when demand weakens, yields rise. When yields rise, borrowing costs explode. And when borrowing costs explode, every pressure point in the economy tightens all at once. There is a moment in every financial system when confidence becomes more important than money itself, and the United States is approaching that moment. Now let's talk about the second force people overlook: corporate debt. Most Americans think rising stock prices mean companies are strong, but look closer and you'll see a structural fragility that is far more troubling. Corporate debt in the United States has crossed $35 trillion. Much of this debt was accumulated during the years of ultra-low interest rates, when borrowing felt cheap and risk seemed distant. But those debts are now maturing into a completely different environment. Corporations that borrowed at 2 or 3% a few years ago are now refinancing at 6, 7, or even 8%. This is not a minor adjustment. It is a tectonic shift, the financial equivalent of oxygen suddenly becoming scarce. Companies are now facing higher interest costs without higher productivity. They are raising prices to compensate, which feeds inflation. Inflation then forces the Fed to hold rates higher for longer, which increases refinancing pain, which triggers more price hikes, and the cycle repeats. This is the engine behind the so-called resilience of the U.S. economy. It is not strength. It is a survival loop, a loop that eventually snaps. Now add a third force: the slow erosion of global trust in the dollar. This is not a collapse. Collapses are loud. This is erosion, and erosion is silent. Across Asia, Africa, South America, and the Middle East, more countries are settling trade in local currencies. Energy deals, agricultural shipments, mineral contracts, and financial settlements are being denominated in alternative systems. Each shift is small on its own, but together they form a pattern. The dollar has not crashed because its status is enormous, and enormous structures take time to fall. But the decline has already begun, measured not in headlines but in percentages. Dollar share in global reserves has fallen. Dollar use in trade settlement has fallen. Dollar dominance in central bank portfolios has fallen. And here is the truth the government will never say aloud. The U.S. economy is not being held up by strength. It is being held up by momentum. Momentum from decades of dominance, momentum from global habit, momentum from a system that still works but works less each year. Momentum hides weakness. Weakness eventually destroys momentum. And now we arrive at the part that matters most for the coming crash. It is not triggered by bad news. Bad news has been here for years. It is triggered when the last thread of confidence snaps. Confidence can absorb inflation. It can absorb debt. It can absorb political division. It can absorb global instability. But it cannot absorb the moment when households, corporations, markets, and foreign governments all decide at the same time that the system no longer feels trustworthy. That moment is closer than most people realize. Because the true risk is not the debt, or inflation, or slowing growth. The true risk is that all these forces are reaching their limits together. A slowdown in the consumer cycle, a rollover in corporate margins, a tightening credit window, a weakening dollar, a fatigued labor market, a strained treasury market. Each of these forces alone is manageable. Together, they form the landscape of a delayed collapse. And delayed collapses never fall gently. The longer the fall is postponed, the faster it accelerates when the system finally gives way. In the next section, we will break down the single indicator that exposes how close this moment truly is, and why almost no one is paying attention to it. There is one indicator that exposes exactly how close the U.S. economy is to breaking, yet almost no one in mainstream media talks about it. It has nothing to do with unemployment or GDP, nothing to do with inflation or rate cuts, and nothing to do with consumer confidence surveys. It sits underneath all of those, a structural signal that reveals the true fragility of the system: liquidity stress. The U.S. economy hasn't crashed yet for one reason alone. There is still enough liquidity, barely to keep the gears turning, but this liquidity is not coming from strength or growth. It is coming from a complex mix of government spending, corporate debt rollover, and the sheer inertia of global dollar usage. And every one of those sources is weakening at the same time. Liquidity is the bloodstream of the economy. When it flows, markets function, companies borrow, consumers spend, and the system moves. When it dries up, the system freezes, confidence breaks, and crashes accelerate. What most people don't realize is that the United States is now relying on increasingly unstable sources of liquidity. Corporations are rolling over debt at higher interest rates, which drains their margins. Households are relying on credit to survive, not prosper, which weakens future demand. The government is issuing trillions in new debt just to stay afloat, which forces the Treasury market to absorb volumes it was never designed to handle. Meanwhile, foreign buyers, who once stabilized the system, are quietly stepping back, leaving the Federal Reserve and domestic institutions to shoulder the load. The cracks are already visible. Treasury auctions are showing softer demand. Bid-to-cover ratios are weaker. Indirect bidders, often foreign governments, are pulling away from long-duration debt. Yields swing sharply with the slightest shift in sentiment, something that never used to happen when the world trusted U.S. debt without hesitation. The Treasury market is becoming more fragile, not because the U.S. economy is collapsing today, but because the underlying trust that sustained it for decades is slowly eroding. And once liquidity in treasuries becomes unstable, every other financial market becomes unstable too, because treasuries are the collateral foundation for the entire global financial system. Now consider what happens when households reach their credit limits. Consumer spending drives about 70% of U.S. GDP. As credit card balances rise, savings shrink, and delinquency rates climb, the consumer engine begins to sputter. This doesn't cause an immediate crash, but it removes one of the key supports that kept the economy functioning. Companies feel that slowdown through weaker demand, softer earnings, and margin compression. They respond by cutting investments, slowing hiring, and eventually laying off workers. This weakens consumer spending even more, creating a negative feedback loop. While this loop takes time to fully unfold, it also accelerates quickly once it begins, especially when credit conditions tighten. Corporate liquidity is also weakening. Companies that relied on cheap debt now face refinancing at higher rates. The rollover wave that analysts have warned about for years is no longer theoretical, it is happening. As interest costs rise, companies protect earnings through price increases, cost cuts, and financial engineering. But none of these strategies improve real productivity. They simply delay the problem. And delayed problems are the most dangerous kind because they build pressure under the surface. When a company can no longer roll over its debt at a manageable rate, the liquidity disappears overnight. This is how corporate failures begin, not in dramatic collapses, but in silent squeezes that accumulate until one event exposes the stress. Add to this the gradual weakening of the dollar's global role. Fewer transactions are being settled in dollars. Reserves are diversifying. Commodity contracts are shifting. Even allies are exploring alternatives. These changes don't make headlines daily, but they reshape liquidity flows. The dollar's dominance is what allowed the U.S. to borrow endlessly and cheaply. As that dominance erodes, the cost of liquidity rises, the availability of liquidity falls, and the fragility increases across the system. The economy still stands because enough countries and institutions still default to the dollar. But the trend is clear. Reliance is diminishing, not growing. All these forces converge on the same point. The U.S. economy has not crashed because liquidity hasn't fully broken yet, but the sources of that liquidity are deteriorating month by month. Crashes don't happen when people expect them. They happen when the last cushion of liquidity disappears, and the system is forced to confront reality without support. The real danger is not the current weakness, but the thinning margin between stability and collapse. In the next part, we will examine precisely what breaks first, how confidence collapses when liquidity stress reaches its peak, and why delayed crashes hit harder than immediate ones. The warning signs are already here, and understanding them is the key to seeing what comes next. Everything we have examined so far leads to one unavoidable reality. The U.S. economy is operating on borrowed time. The supports holding it up are not strong foundations but temporary structures that have been stretched far beyond what they were designed to handle. Household credit is near its limit, corporate refinancing is tightening, Treasury markets are becoming more fragile, and global trust in the dollar is slowly eroding. None of these issues cause an immediate collapse on their own, but together they create the exact conditions under which delayed crashes occur. A system can withstand strain, imbalance, and pressure for years, but once confidence weakens and liquidity thins, the smallest shock becomes the final trigger. Crashes rarely begin with dramatic events. They begin quietly. A major company misses earnings, a regional bank fails, a treasury auction underperforms, a foreign government announces a shift in reserve strategy. None of these events look catastrophic alone, but each one chips away at the belief that the system is stable. Confidence does not break all at once. It fractures in stages, each fracture weakening the next until something insignificant becomes the spark that ignites everything. Analysts often look for the loud explosion, but the real warning is in the silent tightening that precedes it. Consider the consumer sector. When households can no longer borrow to sustain spending, demand falls. Companies feel the slowdown and respond with layoffs. Layoffs weaken demand further, and earnings begin to contract. Markets may ignore the first signs, just as they have ignored warning after warning over the past few years, dismissing them as temporary or exaggerated. But once earnings shrink across enough sectors, confidence in corporate valuations fades. Stock prices begin to slip, not because of panic but because the narrative supporting them no longer holds. This is how momentum reverses, not through chaos, but through the slow erosion of belief. The corporate sector faces a similar pressure. As refinancing costs rise, companies that appear profitable on paper begin to struggle with cash flow. Margins tighten, investment slows, and debt burdens increase. A company that could survive in a low-rate environment suddenly becomes vulnerable. Investors sense weakness and start reallocating. Credit spreads widen. Lenders demand higher premiums. Funding becomes more expensive and less available. The tightening spreads from smaller firms to larger ones, and eventually to companies considered too important to fail. At that point, the system enters a phase where a single default can trigger a chain reaction. Meanwhile, the global financial system is adjusting to a world where the dollar is not the only option. Even incremental shifts away from dollar settlement change liquidity patterns. The United States has relied for decades on the assumption that global demand for dollars and treasuries would never meaningfully decline. But when that assumption weakens, the government must issue debt into a market with fewer reliable buyers. Yields rise, interest payments increase, deficits grow, and the pressure intensifies. The government cannot cut spending without triggering recession, and it cannot increase spending without worsening the debt cycle. It becomes locked in a downward spiral where every solution creates a new problem. This is the point where delayed crashes become inevitable. When liquidity is thin, debt is expensive, trust is weakening, and global support is fading, the system does not need a crisis. It simply needs one more strain than it can handle. The U.S. economy has not crashed yet because the forces holding it together still have some strength left. But those forces are not infinite. They are weakening, and once they break, the decline will not be gradual. Systems that bend for too long do not ease into collapse, they snap. What makes the coming shift so dangerous is not just the economic strain, but the psychological shift that follows. As long as people believe the system is stable, the system endures. But once enough people decide the system feels unstable, the behavior of millions changes at the same time. Investors sell faster. Consumers pull back sooner. Businesses delay hiring longer. Foreign governments diversify reserves more aggressively. This collective shift is what transforms ordinary weakness into systemic failure. The truth is simple. The U.S. economy hasn't crashed yet because it has been held up by temporary supports, financial engineering, and global habits that were formed in a different era. Those supports are fading. The habits are changing. The pressures are converging. And when they reach their breaking point, the correction will not be something the government can pause or reverse. It will be the system resetting to what it actually is, not what the numbers appear to show. The warning signs are already visible. Liquidity stress, weakening consumer strength, debt rollover pressure eroding global trust, fragile treasury markets, and tightening financial conditions. They are not predictions. They are realities. And they reveal a simple but unsettling truth. The U.S. economy has not crashed yet, not because it is safe, but because the collapse has been delayed. And delayed collapses always hit hardest when they finally arrive. This is the moment to understand the forces at work, not after the break happens but before it. Because once the final support gives way, the shock will not be slow, and it will not be subtle. It will be the sudden shift that follows years of ignored warnings, and by then the truth they hid from you will no longer be hidden. It will be undeniable.